Imagine, like walking into a boardroom, right?
Right.
And you ask to see the company's revenue. And the CEO proudly hands you a piece of paper with just a giant zero on it.
Oh, wow. Yeah.
And then Wall Street turns around and hands that exact same CEO a valuation of over $2 billion.
I mean, it sounds like the setup to a joke about, the dot-com bubble or something.
It really does.
Yeah.
But in the hyper-specialized world of clinical stage biopharmaceuticals, a zero-revenue, multi-billion-dollar valuation isn't a punchline. It's actually the ultimate paradox of event-driven investing.
Right.
So today we're taking deep dives into one of the most explosive, high-stakes examples of this whole phenomenon, which is Sellas Life Sciences Group, or SLS.
Yeah, and this is a truly fascinating case study.
It is, because this is a clinical stage company with essentially no commercial revenue.
Yeah.
None. Yet we've watched its stock price surge over 500% in a single year, capturing this massive market capitalization.
That's $2.1 billion market cap, to be exact.
Exactly. So the question for you, the listener, is how? Like, how does a fundamental black hole attract billions of dollars in capital? We've got financial data, clinical trial news, technical momentum metrics, and these really polarized market sentiment reports.
You really have to throw standard value investing right out the window here.
Okay, let's unpack this. Because to truly grasp the hype and the sheer volatility surrounding this stock, we have to start with the financials. And I use the word financials loosely here because, well, the metrics are completely inverted.
They absolutely break standard valuation models. I mean, totally break them.
Right. Like, we're looking at a trailing price-to-sales ratio sitting at 726.16.
Which is, yeah, that's absurd.
Not a PS of 7, which would already be, pretty aggressive for a mature company.
Yeah.
726. But the metric that really caught my eye is the margin profile. They are burning cash at a terrifying rate.
Oh, yeah. The trailing 12-month net margin is, what, negative 736%?
Negative 736.21%. But somehow, they are simultaneously reporting a gross margin of 93.1%. I mean, I need you to help me square that circle.
Right. It seems impossible.
How can a company hemorrhaging that much cash maintain a 93% gross margin on the tiny trickle of revenue they actually do have?
So it comes down to how biotech licensing and milestone payments are structured. That 93% gross margin isn't reflecting like steady day-to-day sales of a product you'd find on a pharmacy shelf.
Okay, so what is it?
Well, when a clinical stage biotech gets a payment, say a larger pharmaceutical partner pays them for hitting a specific clinical milestone, the actual cost of goods sold for that specific transaction is essentially zero.
Oh, because the intellectual property was already developed, like, years ago.
Exactly. The hard work is done on that specific IP.
Ah, so it's a bit like building a rocket ship, right?
Sure.
The massive, terrifying cash burn up front is you designing the rocket, sourcing the parts, doing the math.
Yes, the R&D.
Right, the R&D. And that puts you millions in debt. That's your massive negative net margin. But the entire valuation of the company is based on the blueprint of a moon landing that hasn't happened yet.
That's a perfect way to look at it. The negative cash flow isn't a failure of the business model. It is the mandatory cost of admission for being a micro-cap or small-cap biotech company.
They just have to burn that cash.
They do. They are racing toward a clinical inflection point, pouring every single cent of liquidity into research and development for their phase 3 trials. So their free cash flow has to be negative.
Which perfectly explains why they're trading at a price-to-book ratio of 19.60. The market couldn't care less about the cash currently sitting in their checking account.
Or the physical desks in their office.
Right.
The market is pricing in the future intangible value of their clinical pipeline.
They're paying for the blueprint.
Exactly. Investors are paying a massive premium for the probability that this specific pipeline will eventually cross the finish line.
But, I mean, no one funds a multi-billion-dollar cash furnace just for fun. That massive premium is the exact price tag for building an impenetrable biological moat. So let's look at what that money is actually buying.
Let's do it.
Sellas' primary moat is built around their proprietary intellectual property. It's an immunotherapy known as GPS, or Galin-Pepimut-S. And this therapy targets something called the Wilms tumor 1, or WT1 oncogene.
And the WT1 target is incredibly compelling from an oncology standpoint. Like, an oncogene is basically a mutated gene that drives cancer growth.
Right.
And WT1 is a specific protein that is highly expressed across a wide variety of hematologic malignancies. So blood cancers, and solid tumors.
So if we think of WT1 as like a highly visible flashing neon sign on the surface of a cancer cell.
Their GPS therapy is basically training the patient's own immune system to spot that neon sign and attack it. It's targeted immunotherapy.
Okay, follow that.
But the real value driver for Sellas isn't just the theoretical science, it's where they are applying it. They have a massive first-mover advantage in a high unmet need niche. Specifically, they are focusing on the Phase 3 REGAL trial for AML-CR2 patients.
Okay, wait. Let's slow down on the medical jargon because this is where the valuation starts to actually make sense to me. AML is acute myeloid leukemia, which is notoriously aggressive.
Very aggressive.
But the CR2 part second, complete remission, that's the key here, right? Like, these aren't newly diagnosed patients.
No, not at all.
These are patients who fought off the leukemia, went into remission, relapsed, and have now somehow managed to fight their way back into a second remission.
And that is a profoundly vulnerable patient population. I mean, the statistical probability of the cancer returning a third time is staggeringly high.
Wow.
And the standard of care medical options at that specific stage are severely, severely limited. The unmet need is just massive.
Oh, if Sellas can prove their GPS therapy keeps these patients in remission longer, they effectively own that entire treatment niche.
They do. They'd have a monopoly.
But I still get hung up on the valuation. Even if the science is brilliant, couldn't, a Pfizer or a Merck just come in with their endless billions and build a better WT1 targeting drug?
Well, what's fascinating here is they could try, but they can't buy time. And time is the ultimate moat in biotech.
Because of the regulatory hurdles.
Exactly. A Phase 3 trial is the final, most expensive, and most rigorously scrutinized hurdle before a company can seek FDA approval. Because Sellas is already executing a Phase 3 trial, any competitor trying to copy this therapy
Would be starting from scratch.
Right. They would face years of preclinical Phase 1 and Phase 2 trials just to catch up to where Sellas is right now. That solidifies their moat.
So the regulatory timeline itself is the defensive barrier.
Absolutely. You can have all the capital in the world, but you still have to wait years to gather long-term safety and efficacy data. Sellas has already paid that time tax.
Here's where it gets really interesting, though. We've established the structural moat and the groundbreaking potential of the science. But Wall Street isn't a hospital, right? It's a marketplace.
Oh, yeah.
And the way traders are reacting to this impending Phase 3 data readout is, well, it's violent.
The momentum profile is staggering. I mean, even for biotech.
Yeah, when you look at the raw momentum, this stock is up 200.26% year to date. And over a 52-week window, it surged 518.57%.
It's been a wild ride.
It touched a recent high of $15.87 back on June 30th before pulling back and settling around $11.32.
Right, it's consolidating.
And with a beta 2.51, we aren't just talking about standard volatility. We're talking about a stock that is coiling up to aggressively gap up or gap down the millisecond that Phase 3 data drops.
The options chain is certainly pricing in a massive dislocation.
But amidst all this volatility, there is a glaring massive signal from the data that the smart money is moving, which is the insider flow. Over a recent 90-day window, company insiders bought 1,065,000 shares of their own stock.
That is a lot of shares.
And the number of shares sold by insiders in that same window? 0. Not a single share.
Which gives them an insider MSPR or sentiment score of a perfect 100. On a high beta pre-catalyst biotech, that is incredibly rare.
Which brings me to a hypothesis, and I want you to tear this apart if I'm wrong. When executives are cluster buying 1 million shares of a wildly volatile stock right before a binary Phase 3 data readout, is this genuine confidence? Or is it like a calculated, highly visible gamble by management to artificially project confidence, hoping to trigger a momentum run?
I mean, it's a cynical theory, but in this sector, you always have to consider it. However, the sheer size of the cluster buying here heavily points toward genuine confidence.
Okay, why? Because they don't have the data yet, right?
No, management obviously doesn't have the final unblinded data. The trial protocol strictly forbids that. But they have incredible visibility into the mechanics of the trial. They know the enrollment speed, they know the blinded event rates, they hear the anecdotal feedback from the clinical sites.
So they might not know the exact score of the game, but they know their team is playing really, really well.
Precisely. And when you combine this aggressive insider flow with the high beta and the unconfirmed speculative chatter about institutional whale options activity ahead of this binary readout,
It's a powder keg.
it is a highly combustible setup. If the phase 3 data drops and hits statistical significance, you have a textbook setup for a potential short squeeze.
The valuation wouldn't just hold, it would violently expand.
It would re-rate instantly.
But, every rocket faces gravitational pull.
Yeah.
And to give you, the listener, the full picture of this deep dive, we have to look at the deeply polarized sentiment here. For every analyst screaming about an imminent short squeeze, there is a bear report calling this stock a total house of cards.
Right. The bears argue the stock is priced for perfection, and fundamental reality just doesn't justify a $2.5 to $3 billion valuation.
Exactly. And I want to zero in on a very specific clinical risk that the short sellers are citing, because honestly, I am genuinely confused by their logic.
You're talking about the selection bias argument.
Yes, the bears are pointing to delayed events in the Regal trial as a massive red flag. Now, in oncology, an event usually means a patient relapsing or sadly passing away. The trial is designed to run until a specific number of these tragic events occur, right?
Correct. The FDA requires a certain threshold of events to prove statistical significance between the group receiving the drug and the control group.
Okay, so if the events are delayed, that means people are living longer without relapsing, the patients are surviving. How on earth do the bears spin patients living longer into a short thesis? That seems like a massive win for the drug.
This raises an important question, and it's one that trips up a lot of investors. It looks like a massive win on the surface. But you have to look at the control group. This is where the concept of selection bias comes in.
Okay, decode that for us. What is selection bias in this context?
Imagine you were running a clinical trial to test a new sports drink, and you want to see if it improves cardiovascular endurance. But completely by accident, the clinic you are using happens to enroll a dozen Olympic marathon runners.
Well, they're going to have incredible endurance regardless of what they drink.
Exactly. Now apply that to oncology.
Hmm.
The bears are theorizing that Sellas might have inadvertently enrolled an exceptionally resilient cohort of patients into the Regal trial. If the patients in the control group, the ones not getting the GPS therapy, are also living much longer than historical averages.
It ruins your statistical baseline.
Yes.
Yeah.
The delayed events aren't necessarily proof that the drug's a medical miracle. They might just be proof that the trial enrolled incredibly tough patients.
Wow. Okay, so if both groups are surviving way past expectations, the gap between the drug group and the control group narrows.
Right. And when the data is finally unblinded, that difference might not cross the threshold for statistical significance.
So the exact same data point, these delayed trial events, is being weaponized by both sides. The bulls see it as proof of efficacy, and the bears see it as proof of a flawed baseline.
It perfectly illustrates the terrifying binary nature of this risk. If the bears are right about the selection bias, that astronomical 726 times price-to-sales ratio will crater.
It'll just collapse.
Completely. But if the bulls are right, and successful AML data unlocks billions in peak sales, it instantly validates the premium.
And there's an entirely separate macroeconomic layer providing a tailwind to this entire debate, which is the current interest rate environment. The sentiment reports highlight that clinical stage biotech is currently acting as a rate cut trade in disguise.
Yes, the macro picture is huge right now.
We know the Federal Reserve influences the broader markets.
Yeah.
But how do falling yields directly impact a company whose entire existence is isolated inside the leukemia trial?
You have to look at how Wall Street builds valuation models. A clinical stage biotech is a long-duration asset. The massive payoff, the commercial revenue, is projected years into the future.
Because they have to finish the trial, get FDA approval, build a sales team. It takes years.
Exactly. And in financial modeling, future cash flows are heavily discounted when current interest rates are high. If you can get a risk-free 5% yield just parking your capital in short-term government bonds, you demand a massive premium to take a risk on a zero-revenue biotech.
But when yields start falling, the math flips.
It flips violently. As the Fed cuts rates, the risk-free yield drops. Capital rotates out of safe havens and starts hunting for high beta growth. Falling yields provide a cushion for the entire biotech sector.
So even if the clinical data hasn't fundamentally changed, the market is suddenly willing to pay a higher multiple for the potential of that data, simply because money is getting cheaper.
Precisely. It acts as a multiplier for the underlying momentum.
So what does this all mean? We've looked at the terrifying cash burn and how it functions as a cost of admission. We've explored the targeted science, the WT1 oncogene, the aggressive million-share insider buying spree, and that absolute high-wire act of statistical selection bias versus genuine efficacy.
It's a lot to weigh.
It is. The core takeaway here for you listening is understanding the sheer mechanics of an event-driven biotech stock. The wild ride of Sellas Life Sciences is entirely tethered to the impending Phase 3 real trial data. It is balanced on a knife's edge of insider confidence and massive valuation risks.
And if we connect this back to the bigger picture, it's vital to remember what is actually sitting at the center of this financial whirlwind. Beyond the technical charts, the high beta volatility, and the whales battling it out in the options chain.
There is a potential life-changing treatment for leukemia.
Right. This highlights the dual purpose of the biotech market. It is simultaneously an arena for ruthless binary financial speculation and the primary engine for human medical advancement.
The money has to come from somewhere to fund the science. And that leaves us with a final thought to ponder as we wrap up this deep dive. We've spent this time dissecting how a $2 billion valuation rests on the binary outcome of a single Phase 3 trial. A slight statistical anomaly, like a minor selection bias in the control group, could wipe out a decade of research and billions in capital, regardless of whether the drug actually has merit in the real world.
It's a terrifying thought.
It begs the question, how many other potential medical miracles are out there right now, trapped in this high-stakes, all-or-nothing financial mechanism where science and Wall Street speculation collide? We're all just staring at the data, waiting to see if humanity takes a step forward or if the market simply reprices the risk.